Hello everybody, CapLand India Trust just announced the numbers for FY22, and I think the story for this full year result is that the growth resumes again after the hiccups in due to COVID and of course the lowered occupancies at Chennai last year. The highlights is quite pleasing. Full year DPU is above 8 cents once again after what happened last year, which was a bit of a disappointment. You can see the share price correction being quite severe as well. Of course, last year was a heavy year for REITs, right, because of Fed rate hike fears. So while we've seen things recovering a little bit here and there, so full year wise, DPU is up 5%, and this is quite encouraging given the progressions in the FX space, right? Because INR continues to depreciate against the very mighty Sing dollar. But I think the numbers are quite interesting. The physical attendance is up to 46% from 11%, which is still very far below the 100% or 90+% in the past, right? But I think the properties are still quite well tenanted. Leases are still quite long. I don't think the companies are gonna give up the spaces anytime soon. So I think there's gonna be quite a fair bit of recovery in terms of physical attendance. But it still remains to be seen, right? These work from home initiatives is this going to have a permanent impact on the occupancies at the IT parks. So we have to wait and see for that. Renewals are quite active, and so far the rental reversions are also quite impressive. I think what is quite very interesting this year is of course the development of the data centers arm. So they used to have IT parks, and then they expanded into logistics and industrials, and this is the latest development, right? Which is I think very interesting because being a business trust, they can do greenfield and brownfield developments, and this is actually one big growth engine going forward, I think. This is the INR movements against the Sing. You can see, boom, 1 year it just rocket up, right? The Sing has appreciated against the INR consistently. So if you look at the year-on-year change is 11%, and average to average change around 2.5 to 3%. So that have caused an impact on the NAV. So you have seen that the NAV collapsed, fell actually by 6% to 1.11 compared to last year. So this is quite interesting because debt maturity profile. This is quite a lot of debt expiring in FY23 this year. So all this chart will probably have an impact on the interest overall. So look at this year, the average debt of cost of debt is 5.9%. So this number will go up, I think, with the expiries here and the refi. The hedge ratio is 76% as well, which is kind of okay-ish, not that low, not that high either. So gearing is at 37%. So I think the impact of the rate hikes from RBI and the Fed will have an impact on this guy. So we probably see this number going up next year. Because for them, they have INR denominated debt as well as a Sing denominated debt, right? So both will be going up in terms of cost of debt. So we expect to see some impact over here. But nonetheless, the numbers are kind of okay-ish. The ISA is at 3.1 times, gearing at 37 times. Not too high, not too low. The hedging ratio is a bit here and there as well. So everything is kind of in the middle. The occupancy is quite nice to see though. Especially at the ITPC in Chennai, so it's back at 92% in terms of physical occupancy. And you can see that for this guy, the properties are in general more highly occupied compared to the regionals, the market occupancy of the peripherals. So for Chennai is now back to 92%. So this was the numbers from 1 year ago, right? When this number dropped to 65%, and the markets went crazy, right? They were like, oh no, my occupancy is down. Let's sell everything, and the share price really fell. But now everything is back to 92%. Which should be good news for the trust, but I think nowadays the fear is on rate hikes, and everybody is just worrying about the inflation and rate hikes, right? So this is the stock market. Once the stock market is obsessed about a particular problem, you'll be obsessed about it for like months and months and months. So initially it was about the occupancy in Chennai, and people were like screaming their heads off. Now it's recovered, but now people are screaming their heads off about inflation and rate hikes. So this is the market. Rental reversions were quite positive. In general, it's still positive at the Chennai, Cyberville and stuff. But you can see weakness in the ITBB and ITPC as well. So both are down. But I think in general, the numbers are still quite healthy. But it's not going to matter too much as well because a lot of the leases are very long, right? Average lease term is like 6.5 years. lease expiry is 3.7 years. So only 10% expiring this year. So I don't think it's gonna have a big impact on the rental income. I think the growth engine for this guy still continues, mainly because of the multiple levers they can have to play with. Look at the cap rates, right? So the cap rates hasn't moved that much, despite the rate hikes and stuff. What is interesting though, I think is these two numbers. Look at the cap rate for DC in India, right? It's a 9% over here for CapLand DC, Navi, Mumbai, and also for CapLand DC, ITPH, it's a 9%. So cap rate of 9% for DC in India is quite attractive, right? Especially if you look at the capital structure, their units are yielding around 6%, and the cost of debt is around 6+%. So actually, with a bit of funding here and there, they can still do very accretive acquisitions and funding and developments and so on and so forth. They can do everything, right? They can do ITBs, they can do logistics, they can do warehouses. Now they can do DCs. And I think DCs is going to be a big story going forward. Especially look at what's happening in the Indian telco market with Reliance really bulking up and capital flows into India. And I think the Indian government, led by Modi, is also doing very smart things. They are pretty much sitting at all tables, be it with friends with China, friends with the Quad, friends with the US, even friends with Russia and stuff. So they are pretty much playing a very deft diplomatic game all over and sitting on all tables negotiating with all giants. So I think actually India is in a very interesting position, benefiting from the conflicts between the major powers. As a major power in itself, sitting in the middle of everybody and participating in all tables. So it's quite interesting, right? So look at the growth and expansion plans for the year. It's quite an active year for AIT or CapLand India Trust. Now it's called. They completed the acquisition of the warehouse. They completed the acquisition of this Mahindra World City, and now phase 2 is gonna be proposed to be acquired. They have inked an agreement with LNT Realty to develop the spaces, 6 million square feet of prime office spaces. So this is another growth engine. Remember the cap rate is still pretty high, right? 8+%. ITBB, there's gonna be another data center, and then there's gonna be another data center here, and then ITBB acquisition also. So another acquisition over here. So you can see plenty of acquisitions all over the place, right? The cap rates are very healthy in the 8 to 9% range. So actually for this guy, this can be very significant inorganic M&A growth going ahead on top of the organic growth from the rental reversions. So I think the growth plans for this guy still continues unabated, and looking forward to the next year's earnings. While in the meantime, earning 8 cents DPU dividend, so pretty enjoyable.